this is primarily joint work with Professor Dimitris Bertsimas, Claudio Sanchez, Michalis Markakis, and Nira Sarna. So they're based at the MIT ESA Business School and Munich Re, accordingly. And so what I will be doing is like, I will first kind of motivate how I ended up working on this topic, what the field of algorithmic insurance is all about these days. And then I will kind of talk about two different quantitative frameworks that I have worked with, to try to provide kind of like more rigorous methods that try to tackle some of the core challenges in the field. And then, given that we only have 30 to 35 minutes at our disposal, I will not go into too much depth about the technical details. I will try to kind of provide the core intuition and the core insights that we got from these lines of work. And then I will leave it open for questions where we can, of course, deep dive into any of the topics that is more of interest to you. So, I don't think I need to spend too much time kind of motivating why AI risk is a hot topic these days. The only thing I would say is that it is a topic that has attracted a lot of attention from many different stakeholders, from business leaders to governments to regulators. Recently, we saw kind of like governments moving towards like liability rules and specific governance frameworks around AI. Other governments shifting away from this idea of regulating AI in kind of like fears of like stifling innovation. And so kind of like a core question that I want to address while entering this field was whether we can manage AI risk in a scalable, effective, and market efficient manner that doesn't have the drawbacks that we're seeing in traditional forms of AI governance and regulation. And the idea of kind of like working along with insurance to try to kind of like manage the risks of this powerful technology actually has a very good analogy with car insurance. And just to give you the analogy here, about around the end of the First World War, innovation in the automotive industry had reached a point where manufacturers could produce cars at a mass scale and at a price that would be affordable for the average household across the West. Now, the problem was that while like cars were made available and they were in price accessible to the average family in the UK, in the United States, still a lot of people were resistant to buying a car. And the reason was that they were afraid of what's going to happen in the case of an accident. Now, the issue of kind of like fear in kind of like buying into the technology has kind of like very long roots. But what really changed the consumer attitude in the case of the automotive industry was the enactment of the first Car Traffic Act and kind of like the idea of linking together responsibility to third-party liability, to the point that to this day it's illegal to drive a car without having any kind of car insurance. And so I believe that to this day, we are actually in exactly the same setting with AI models. We're asking decision makers to take on the risk of AI, similarly to how we're asking the average family to take on the risk of a car, but we do not provide any kind of financial guarantee, any type of like insurance policy as a default for them to use it. And so if I ask you today to drive a car without insurance, I don't know how many of you would actually be comfortable doing that. But in many countries around the world is actually legal. But if I ask you to use a powerful AI model, everybody seems very willing to do that so. But depending on the application, some business leaders seem reluctant. And so this is where the idea of algorithmic insurance came into play. Actually, I started working on this topic and thinking around this back in 2021 when I was finishing my PhD, focusing on kind of like machine learning for precision medicine. And at the time, I realized that we were doing all this work in developing powerful machine learning tools that can help doctors make better decisions for patients. But when looking at the actual penetration of these AI tools into the clinical practice, it was actually minimal. Very, very few doctors, even in kind of like the cases of COVID-19, where the need for these models was really, really pressing, were very keen in looking and actually deploying AI tools in practice. And the reason was that there was no effective management of that AI underlying risk. So to try to formalize it, what is algorithmic insurance? It's coverage that addresses unintended outcomes resulting directly from an AI system's normal operation, where outcomes fall within the declared scope but diverge from intended behavior. And so that's very important because this is the distinguishing feature between algorithmic or AI insurance and cyber insurance. For a long time, there was a bit of like a confusion in the field on what is the discrepancy between these two. But here we're actually looking at errors that happen within the declared scope, that there is no external agent coming in and hijacking the system. And insurance is in terms of providing coverage for the AI model. So to kind of like demonstrate that more effectively, I will show you this diagram. Essentially, we have 4 different players in this market. We have the machine learning provider, which is a tech company that offers a machine learning model to a machine learning client. In this case, this could be a hospital. The hospital, in exchange for having the machine learning model, is paying a machine learning model license fee. That fee and that model allows the hospital to provide an ML-enhanced service that eventually touches upon the machine learning client's customers. These are the patients. And in exchange, the patients pay a service fee. Now, this is the traditional kind of like pipeline of the current machine learning model supply chain. The problem is that currently there is no linkage between the patient and the tech company that is actually developing the model in case there is a risk that materializes within the patient setting. So to remedy that, algorithmic insurers are coming into play to provide insurance coverage to the hospital, to the machine learning client, to the setting where the model is being deployed against claims that are being kind of like raised by the machine learning client's customers. And in exchange, they receive a premium, an algorithmic insurance premium from the machine learning provider. Now, this is important because the premium is getting paid by the entity that develops the machine learning model, and the coverage is being provided to the setting where the model is being deployed. Of course, you can also think of settings where there is no insurer and that you have a self-insurance setting where the machine learning provider retains all the risk internally, but they are at the same time responsible for providing the insurance coverage to the patients. Many self-driving companies these days are actually doing that right now. And I'm happy to go into the details of when do we see more common paradigms of like self-insurance versus third-party insurance. But for now, I'm going to kind of like ask you to focus on the third-party insurance problem, which is the most common one we see in these days. So what are kind of like at the broad level the benefits of algorithmic insurance? First of all, it acts as a financial transfer vehicle for AI risk. In other words, it allows us to kind of like quantify the risk and put a price value at it. And at the same time, because we have a specific financial kind of like objective that we're seeking to optimize, it directly offers incentive alignment for high quality machine learning models. It doesn't become a necessity to or a requirement or a stringent kind of government guideline that we need to follow, but on the contrary, it is something that like comes and gets embedded into the cost of like offering and deploying that model in practice. So what is our goal here? Our goal is to provide quantitative tools for insurance companies and machine learning modelers in order to estimate the risk of these products for different classes of contracts and algorithms. So paradigms could be car insurance for self-driving cars, medical liability insurance for MRI machines. And 2 of our core industry partners are Munich Re, who already has a unit called Insure.ai offering this kind of coverage, and AXA that recently entered in a partnership with us in Oxford, the University of Edinburgh and Warwick to try to develop a new flow of kind of like models that will cover agentic AI and generative AI. So today I'm going to be talking about 2 different types of risk that we're trying to kind of cover with algorithmic insurance. One case is liability risk with liability insurance. And so you can think of it as the case of having an AI model for predictive maintenance of airplane turbines. If there is a crash because the turbines were not maintained properly, there could be a case of liability going to the developer of the software for the maintenance of the aircraft. Whereas we could also be looking at operational risk that ties to parametric insurance, where you have a model that kind of like covers the risk of maintenance for the airplanes, and essentially you will be incurring the additional cost of extra maintenance for that airplane, or the unnecessary excessive cost of too much maintenance in case you kind of like missed out on your opportunity window. So first, I will be talking about like liability insurance in the context of binary decisions. And in the second part of the talk, I will briefly discuss parametric insurance for regression models. So the paper for the binary classification setting and liability risk is on arXiv, and you can find it at the end of the presentation as well. So let's try to kind of disentangle how would we go about building a very foundational model for liability risk for binary classification, right? So before we define how we provide coverage, we need to think about what is really the expected value of the claims cost that we're going to incur as an insurer. And so that will actually kind of disentangle into two components. On the one hand, you have the claim frequency, how often you will be seeing claims coming from the model. And the second one is claim severity, meaning what is the expected amount I will be paying per claim for that binary classification model. Now, claim severity depends on the damage that is being caused. And even if you look at like traditional settings of liability coverage where the human is the one making the decisions, really you can assume that these parties remain fixed. Independent of whether the algorithm is making the mistake or the human is making the mistake, the claim severity depends on the damage of the decision. So it's a decision-specific component. Claim frequency, on the other hand, is actually dependent on who is making the decision, and it's essentially the probability of underperformance multiplied by the number of times that the model is being used, the number of times this decision is being kind of like deployed. And so really, this is the part that directly connects to AI performance. This component, the number of times the model is being used, is depending on the frequency of model usage. So to illustrate how this would work in practice, I'm going to use a case study for malignant tumor detection for breast cancer. I chose this use case because medical malpractice lawsuits is actually one of the most common forms of kind of litigation for liability in the United States. And breast cancer misdiagnosis is actually the most common type of claim that we would be seeing in the US setting. And in a recent, actually not so recent, but in a 2005 review of claims from Anderson and Troxell for surgical pathology FNA claims, this is a particular form of diagnosis for breast cancer. 9 out of the 10 of these diagnoses, 9 out of 10 cases for claims in terms of liability were driven by false negative and false positive diagnosis. And so this specific procedure of fine needle analysis is now heavily kind of augmented by AI. And so that's why we thought that this could be a powerful use case for illustrating the implementation of algorithmic insurance in the context of healthcare. And so before we jump into the algorithmic insurance setting, let's try to think about how this would work in a purely human-driven process flow. So currently, you take the breast cancer samples, a pathologist is going to review the samples and decide whether this is a malignant tumor or a benign tumor. Depending on that, a woman might be referred for a mastectomy or some other kind of like invasive procedure or radiotherapy in order to kind of treat the cancer, or the woman would be referred back for another kind of like screening test in a finite amount of time. Now, what are the scenarios for medical liability? You'd have the traditional kind of like false positive and false and negative cases. If the patient has cancer, the doctor does not diagnose, and the doctor does not diagnose the cancer. This is the case of a false negative. And if the patient does not have cancer, the doctor diagnoses cancer. This is a case of a false positive. We assume that the claims amount are captured by two random variables, K and L, in this setting. Now, if you had the binary classification model fully replacing the pathologist, essentially what you would have is an output probability P, that the probability that the patient has breast cancer, and the pathology department would specify a classification threshold tau for the probability of being positive at the test. Now, for lower values of tau, the sensitivity is going up, and we are classifying more and more cases of patients with cancer. For higher values of tau, the sensitivity goes down, but we improve the false positive rate, and we are classifying less cases of cancer. So what I want to convey first is that this decision of the classification threshold tau, which is often driven by just like mere maximization of accuracy or some kind of like threshold on sensitivity, is actually an operational lever that controls the flow of patients between the two types of diagnosis, but also kind of controls to a large extent the degree of risk that the kind of clinical pathology department is undertaking by deploying these AI tools in practice. And so to try to understand really what is the optimal classification threshold tau, and is that actually having a big impact when it comes to measuring our liability risk, we model kind of the expected claim cost for a single patient as the probability of a false positive multiplied by the random variable k, plus the probability of a false negative multiplied by the probability L. Now, if we assume that n patients arrive at the hospital, the total expected loss of the insurance company is n multiplied by CML. Now, the differentiation here when we talk about risk is that risk doesn't necessarily mean that I'm trying to minimize my expected value. Usually, when it comes, especially for liability, what we care about is the tail. And the determination of the premium and that the insurance company is going to ask from the machine learning developer really depends on how much risk the company is willing to take. And so to be able to kind of model that risk, we're going to resort to the finance industry and to well-established performance measures of risk, specifically the value at risk VAR and the conditional value at risk CVAR. VAR is expressing what is the maximum loss with a specified confidence level. So if this is the frequency kind of like of the claims that we will be seeing from the deployment of the machine learning model, VAR is really that threshold here, whereas the conditional value at risk kind of like measures the average, the expected value of the losses that fall beyond that kind of VAR cutoff. And CVAR is kind of like a well-known kind of like measure that we can optimize, and because of its convexity, it's actually quite convenient for us to derive like closed form solutions on how it behaves. So what we did in this paper is that we proposed kind of like a stylized model that captures the probability of a false positive and a false negative in a nonlinear trigonometric form for a binary classification model, and using that and the formulation for conditional value at risk, we are trying to understand what is the impact of this classification threshold tau on kind of like the risk that the company is willing to take, and at the same time, how much is this gap going to affect like alternative approaches of setting that threshold, for example, by maximizing accuracy or maximizing expected loss. And then as a second objective, what we're trying to do is understand where is really the value of algorithmic insurance, in what kind of context, in what kind of ways does algorithmic insurance benefit financially firms and insurers compared to kind of being agnostic to this risk management approach. And so in terms of the first result, the optimal characterization of the calibration threshold tau, this is kind of like the first theorem that we have in the paper. I'm not going to go into too much detail. I'm just going to try to give you the intuition. Essentially, the risk minimizing classification threshold depends on the interplay between model quality, which is kind of the variable K here, cost asymmetry between false positive and false negatives, and the class proportions for any given tail scenario set that we have. So essentially, like the case of A that you see here, it measures kind of like false positive cost dominance relative to class imbalance. B is the ratio that measures false negative cost weight scaled by model quality. And we identified three different regimes. The first regime that you see at the top essentially says that like the optimal threshold tau that you should set is equal to the proportion of positive cases in your data. So for example, like you set the threshold tau to exactly the proportion of cases of cancer that you see in your original population. And that locks the threshold to the class proportion, remaining robust and insensitive to cost changes. Now, this is a setting where you have generally a very high false positive cost dominance relative to class imbalance and generally high false negative cost weight relative to model quality. If you are in this intermediate regime where the false positive cost is still relatively high, we see that the actual optimal classification threshold tau adjusts non-linearly with both the model quality and the cost ratio. Whereas when we are in this third regime, we find that the optimal classification threshold tau is driven primarily by the model quality, and more permissive thresholds are allowed as the quality of the machine learning model is actually getting improved. And this is the core intuition just telling us, okay, this is how we would go about setting that optimal threshold tau. And if we try to kind of characterize how does that relate to kind of like the conditional value at risk, like how does this choice of the threshold translates into the conditional value at risk, which is the way we are measuring liability risk in this setting, you can see here that even small discrepancies in the threshold, and I know that here, like, we're having way too many things, right? So on the x-axis, we're presenting the classification threshold tau that the company is willing to set. On the y-axis, we have the conditional value at risk set on a beta level of confidence of 0.95. On the left, we have the C-var. On the right, you see the corresponding expected loss for the same kind of like threshold. And so what you see here is what's going to happen, what is the distance between the conditional value at risk when I set my threshold to the maximum accuracy, which is 0.5 in the setting, versus to the one that is minimizing C-var, which is 0.83. And so what we model is that like the risk penalty, right? So how much the risk is going to increase compared to my baseline C-var scenario is up to 90.8% when I'm maximizing accuracy, or 17.1% when I'm maximizing, when I'm minimizing expected loss. Now, on the left, we have, for example, a false positive dominated cost scenario. On the right, we have a false negative cost dominated scenario. And I guess the key insight from this kind of illustrative example is to show you that small differences in the threshold tau can actually have tremendous impact when you're looking at the tail. They can have like significant repercussions when you're thinking about risk. And to a less extent when we're trying to minimize expected loss. Beyond that, right, like what we try to analyze in the paper, and I have kind of skipped here all the technical results, is that what are kind of the mechanisms under which insurance can lead to better outcomes, in what kind of like ways it can create value for both the insurer, but also for the machine learning client and the developer. And so the kind of like core key takeaways are the following. First of all, that the gap exists, right? So the firm seeking to deploy at the optimal threshold for accuracy and expected loss, and that penalty is quadratic, as you saw in the previous graph, and it's severe. Then for insurers, right, the actual behavior of the doctor is unobservable to you. You have a distribution on how overall, like let's say radiologists are behaving or pathologists are behaving, and you're trying to set it on that. But in contrary, for AI models, we actually have much more visibility because you can mandate as an insurer what is the threshold that you want to set. And because of that, because by mandating the threshold that minimizes risk, you are actually leading to hazard reduction. You're not only doing risk transfer. So this basically allows us to create value on two fronts simultaneously, right? So on the one hand, we can kind of like, the insurer can reduce its own tail exposure by setting the threshold tau to the one that is minimizing the risk. And at the same time, the firm recovers the CVAR penalty it was silently bearing while being kind of more risk aware. So at this point, right, like I'm going to decompose the kind of the value of insurance into two kind of like different components, right? So one is the V base, which is kind of universal available to all firms. So no matter whether you're kind of setting your threshold to maximize accuracy, minimize expected loss, or minimize like CVAR, these kind of benefits that you see on the left materialize for all. Whereas like V calibration is only specific to firms that alternatively, they wouldn't be risk aware. Cases where you would be maximizing accuracy or you would be minimizing expected loss. And so for the V base, right, the first kind of benefit is the idea of risk transfer, right? So the expected claim payments minus the CVAR based premium. Typically, it is negative, right? So the insurer is going to charge a loading kind of factor for taking on the risk from the client. But at the same time, for the clients where they are deploying the machine learning model, this converts the unpredictable tail losses into a fixed cost. And so that's why kind of like that's the basic reason why companies would be keen into taking on insurance. At the same time, it can lead to capital relief, right? So regulatory capital, so access to capital drops from gamma to gamma insurance, because generally insurers have the capability of kind of like taking on capital in a more favorable interest rate. On the right side, so here we see kind of like what is the difference like in the in those that are seeking to calibrate because they are insuring, right? We can see a difference in the expected loss. So this is kind of like switching from an arbitrary tau to tau star. It can impact the observed expected losses, but also it can lead to tail risk reduction. So by definition, CVAR is going to drop by trying to minimize it but in the way we set the threshold tau. And so risk-aware firms gain only from V-base, but risk-unaware firms or accuracy-maximizing firms, let's say, gain from both V-base and V-calibration. And so here you can see kind of like a summary of our results from a study that we did in breast cancer. I'm not going to go into all the details. Here, kind of in black, you see kind of what is the total benefit in terms of value over the optimal level of CVAR for each of these kind of like three scenarios of firms. This is the firm of minimizing CVAR. This is a firm that is trying to minimize expected loss. And this is a firm that is trying to maximize accuracy. And so as expected, you can see that the biggest benefit will come to firms that were originally maximizing accuracy. The blue component that you see here is the impact of expected coverage. So in generally kind of like the claims that you will be getting reimbursed from the insurer. With orange, you're seeing kind of the cost of the premium, so that's why it is negative. And with green, we see the capital relief, so kind of like how much kind of like money you're winning as a firm for being able to kind of like not having to retain that capital on your books. And what is interesting is kind of like these yellow and blue components, which only appear for the maximizing accuracy and minimizing expected loss firms, who as expected like might have high, kind of like bigger or smaller kind of gains and even losses in the case of expected loss, right? Like depending on the setting where they are. And so you can see that like the actual ratios will vary. And in the paper, we actually kind of derive theoretical bounds for these losses. But what is interesting is that the benefit that will come depends a lot on also kind of like what is really the proportion of, let's say, false positive and false negative rates, as well as the relative costs of these mistakes. Now, I have only kind of like a minute left, so I'm going to briefly say kind of like how does that really translate in the context of operational risk for regression. So what I presented before was the case of binary classification and liability risk. But if we were interested in kind of pricing algorithmic insurance for operational risk, essentially what would change is, again, how do we kind of model this probability of underperformance? And when you are in a regression setting, right, you don't have binary decisions saying, well, this was a misdiagnosis of cancer or this was like a false diagnosis of cancer. What you have is a continuous outcome that you're trying to predict. And so when operationalized, this regression model insurance has taken the form of parametric insurance, meaning that insurers provide kind of a fixed distance D plus D minus over the true value of the outcome that you're seeking to predict. And they can provide fixed or variable kind of like reimbursements as a payout every time your regression model makes a prediction that is outside of that set interval. And so in this kind of like second line of work, what we were doing is trying to kind of understand and optimize how big is that interval going to be as a function of the demand function that we're seeing in the market, as well as the premium and the license fee that clients and machine learning developers are willing to pay. And to do that, we actually developed a method for inverse conformal prediction that provides distribution-free coverage guarantees for any fixed like interval D. And so kind of like this is the idea of how conformal prediction works. I'm going to kind of like skip into that. The idea of like inverse conformal prediction allows you to kind of fix that interval around your prediction. So this way we were able to, on the one hand, like optimize how to design a contract for this form of parametric insurance, explain why accuracy metrics are not enough when you're thinking about parametric insurance, similarly to liability insurance, and also provide algorithms to implement this kind of coverage without any distributional assumptions. And so we are very happy that actually the results of our work have been implemented in practice, like our methods have been deployed and within like Munich Re's Insure AI department. And we're currently working, as I said, with AXA on agentic AI flows. So these are the references of the papers that I just presented. Like this last paper offers like is a recent opinion piece with some of my collaborators on kind of the overview of the field of AI insurance right now and what are the core open research challenges that we are seeing and need to be addressed in the future.